hear my introduction anyway. But hello and welcome everyone to Credit Crunched, managing stakeholders in an inflationary environment. My name's Callum, and I lead Dartmouth Partners private equity portfolio company recruitment here in the US. For those that don't know, Dartmouth Partners is an international executive search firm with deep sector knowledge and experience of the private equity ecosystem. Our clients include investors, portfolio companies, lenders, and advisors. Our team of functional experts deliver bespoke recruitment solutions to clients across the globe. Whilst our core mission is clearly to connect talent with opportunity, we also leverage our network to connect customers with knowledge. In that spirit, our objective for today's event is to allow you to leave feeling that the panel provided some insightful, relevant, and actionable takeaways. I'm pleased to hand over to Jennifer Cotton, who'll be moderating the event today, much better than myself. We have had a slight change of panel. Unfortunately, Robert Campbell was unable to attend, but we do have two new faces that Jen will introduce shortly. The event is, of course, being recorded and will be sent to all attendees on the call right now, but also to many of you who will be watching this later at home and have requested a copy online. If you would like to reach out to me in order to speak to any of our panelists after the event, please do so via email. And during the course of the event, please feel free to post questions you may have. Jen, over to you.
Great. Thank you, Callum, and good morning and welcome, everyone. Thank you all for joining us today. I'm very honored and excited to be moderating this panel. Before we begin, though, as Callum said, I'd like to introduce our esteemed panelists. To begin, Abik Das is a partner with Three Hills Capital Partners, a European investment firm that provides preferred capital solutions to entrepreneur-led businesses in the middle market. Its flexible capital solutions range from junior debt to preferred and senior equity and straight equity as well. Abik heads up Three Hills investment and business development activities in North America and recently opened the firm's office in New York. In this role, he is responsible for sourcing and managing investment opportunities across a range of industries. So welcome, Abik. Next, Max McEwen is Managing Director and Senior Member of the Global Finance team at Barings, a diversified global investment firm specializing in public and private fixed income, real estate, and specialist equity markets. In his role, Max is responsible for originating, analyzing, structuring, and monitoring North American and European private finance investments. So welcome, Max. Next, Anne-Marie Peterson is the head of Debt Capital Advisory at Baird, a global and diversified financial services firm. In this capacity, Anne-Marie leads a team of people helping clients execute on acquisition financing, refinancings, growth initiatives, and specialty financings, just to name a few. Next is Justin Pugh, who is a Senior Managing Director and member of the Corporate Finance and Restructuring team at FTI Consulting, a global consulting and advisory firm offering a comprehensive suite of services to assist its clients across many business cycles. In his role, Justin specializes in providing strategic, operational, and financial solutions to firms and their stakeholders across a variety of industries. And last but not least, Melissa Valkovich is a Managing Director at Sound Point Capital Management, an asset management firm with particular expertise in credit strategies, where she is responsible for originating and structuring investment opportunities and serves on the investment committee for Sound Point's strategic capital strategy. So with that, we'll just jump right in. To begin, it seems each day brings new data and opinions on the state of the economy. To kick us off, I'd like to ask our panel how they describe the current lending environment. Would you say you're optimistic, opportunistic, apprehensive? We'll start with Melissa. Why don't you give us your thoughts?
Sure. Good morning, everyone. I think when you talk about the lending environment, opportunistic, skittish, cautious, I think it's a bit of all three. So if you look at, from our standpoint, and my team focuses on direct lending into special situations, and more often than not, that can mean some sort of stress or distress. So candidly, we're seeing our pipeline really start to pick up in the last few months. I think I think there's a lot of businesses, but what's more encouraging about this outlook in our pipeline right now, in contrast to the last, I would say, 5 or so years, is we're starting to see more good business, bad balance sheet dynamic, which is something that, for us as special situation lenders is kind of exactly what we look for, and those are few and far between. I think obviously with the amount of, with rates being so low and the amount of capital thrown at the economy by the Fed, particularly in the US, I think, you just have a lot of over-levered businesses that were incentivized to take on debt in order to expand in ways that perhaps didn't make sense. So we are seeing a lot of good companies, bad balance sheets. So for us, that makes us optimistic. And I think a lot of my peers on the direct lending side that focus more on performing credit, I think what I've seen in the last 2 months, and I think it's kind of interesting, if you look at, I was at a conference in July, and I talked to a lot of direct lenders, and they're like, everything in our portfolio is performing, nothing to see here. We're pretty sanguine about the macro outlook. And then coming back in September and sitting down with folks over the last few weeks, people are starting to get pretty cautious around certain sectors. I would say consumer being the largest one, because they're really starting to see problems show up in their portfolios, particularly on the top line. So I think you're really starting to see rates spike. So I think you are seeing increasing optimism within the more regular way direct lending community.
Thanks, Melissa. Abik, how about you? I think you might have a little bit slightly different view. So how about you? What are you feeling these days?
Yeah. So look, I mean, perhaps, starting with the general economy, which obviously affects the lending environment. I think, a lot of people are talking about a soft landing, and, you hear this soft landing every now and then. And I was reading something from an economist the other day, a lot of people talked about soft landing in 2007 as well. And then we all know what happened in 2008. So, I think generally speaking, I share a lot of what Melissa said. I think I'm quite apprehensive, but having said that, I think in difficult circumstances where traditional lending subsides, so where banks retrench and the traditional sort of capital markets are shut, that's when private capital providers thrive. And so, I think for many of us, irrespective of what strategy you follow, be it more traditional direct lending, all the way to more sort of capital solutions oriented strategies that we follow, I think it actually is a very interesting environment to invest. Yes, there will be quite a few businesses that have fundamentally a sound, good business model, but perhaps a bad balance sheet and over leveraged given the new rate environment that they're in. But I think that generally speaking, there is opportunity, and obviously in this sort of difficult environment that we're in.
Great. Max, how about you? Anything different, or anything you'd like to add from the lending standpoint?
Yeah, I would say we're kind of consistent with what was just articulated by both panelists. I mean, I think we're a performing credit, so we've been very opportunistic. I think the institutional term loan B market, is showing some signs of life finally, but it's been kind of basically closed for most large issuers, at which point private credit stepped in and kind of taken 100% market share. So I think we've been apprehensive on where we are willing to lend into and focused on, a lot of the macroeconomic forces that could impair a business model or demand for one's services. At the same time, we're right now seeing this to be a great opportunity in the right sectors to deploy capital. Rates, with the elevated base rates combined with what's been gapping on the margin or spread for issuers, combined with what has been more of a borrower-friendly market, we view the absolute risk-adjusted return right now to be pretty compelling. As we've seen, kind of spreads kind of remain kind of 75 to 100 basis points wide of where they were called 18 months ago. We don't think that's going to persist. We're starting to see some tightening in the market, and we'd expect that to continue. And as the CLO market issuances kind of, are able to kind of access the AAA capital, and we see the term loan B market kind of swing back into more of an open mindset, I do think.
Pretty consistent. Justin, how about from your perspective? I think these are markets where you probably start to see more activity. What are your views these days? What are you hearing?
Yeah, we've been incredibly active taking care of the long left tail of what occurred over 2020 and 2021. And what I would say is what appeared to be a good business model was much more like a good idea, challenged execution, and an over-levered balance sheet that was driven based off of a good idea. It was not driven off of what I would call four core fundamentals of people, process, systems, data. You know, what I would consider a good executory business model, as opposed to a good idea that led to a frothy market that then led to lending against the idea. And when the idea didn't pan out because of challenged execution, we end up getting brought in many of these circumstances. And so we've obviously seen the rise of private credit taking out some of these otherwise over-levered companies that were able to borrow based on ideas at the 2020, 2021 low interest rate environment levels that are now coming to roost when rates are obviously spiking.
Thanks. I think that's a really helpful perspective to start us off here. So I heard some consistent themes, cautiously optimistic, opportunistic. When you guys think about your portfolios, what are lenders most concerned with these days? So, as you talk about some of those situations, is it the cash flow? Is it covenants? Is it EBITDA growth? Maybe I'll start with Max. What are you guys most focused on as you evaluate these situations?
Yeah, I would say it's cash flow, liquidity, cash flow. So essentially, if you look at the last year or two, when the market was again hot, and I disagree with what Justin said, but there was pretty loose borrowing terms for lenders. You had a fairly material degradation in critical kind of lender protections, whether that's covenants, definitions, EBITDA. So what we've seen is that in light of those terms that are kind of out there and kind of legacy deals, the most likely kind of fulcrum item that would bring someone back to the table is liquidity. So as we are now, I think, settling into what's going to be and persist to be an elevated rate environment, we're very, very focused on cash flows. We monitor our portfolio kind of monthly and quarterly basis, where we play, we often get monthly financials. So, for us, I think it's just making sure companies have adequate liquidity. If not, it's getting to the table earlier with the private equity partners and the management teams to kind of come up with a solution to kind of provide more time for these businesses to kind of either right the ship or conversely look at kind of restructuring the balance sheet given the persistently high rate environment.
Melissa, how about you? Anything to add there? I think you said you're more looking at things opportunistically, maybe more stress situations. So is it different for you these days, or same sort of concerns?
Same, for better or worse. Listen, we invest across the capital structure. We can do ABLs, FILOs, we can do term loans, we can also do more off-balance sheet, non-recourse financing. So everything that Max said when we're doing cash flow loans is absolutely holds true. It's cash flow, cash flow. It's pretty simple from that perspective. But I would say in the last 12 months, just given kind of our somewhat negative outlook on the market, we've been focused more on being top of the capital structure and doing more asset-based or hybrid facilities. So we do asset-based lending against traditional collateral like accounts receivable, as well as more non-traditional collateral like contracted revenue streams from a single customer. So in the vast majority of our asset-based loans, we are off balance sheet in a structure that's non-recourse to the operating company. So for those investments, we're exclusively focused on the performance of the underlying collateral. So for instance, if it's an AR facility, we only care about whether or not Walmart's paying their bills to you. So, but I would say something that I'm hearing more among lenders in the last 6 to 12 months is exit strategy and how do you get your principal paid back. And for us, it's always been a critical piece of the underwrite is how you get your principal back. But I think you have a generation of lenders who are just used to getting refinanced or rolling into a new structure. And the exit strategy wasn't a huge part of the underwrite, and now it is. So I think you have lenders more focused on the viability of projections and what leverage will look like in 3 years. Whereas I think in recent years, maybe that was less of a concern.
I think it's really interesting perspective. I guess just one follow-on question to that is that changing the amount of time? It sounds like there's creativity in terms of trying to finance through these situations, but is it requiring more time for you guys or for the borrowers to gather that information and help you get comfortable with the projection?
Yeah. I think the benefit of these asset-based structures is it's a collateral underwrite versus an enterprise value underwrite, and that's a little bit easier. And if you've already got a field exam and an inventory report, maybe we just need to do a refresh on that, and we can kind of take a look at the collateral. And particularly when we're doing these off-balance sheet AR facilities, it's something that we do a lot of. We can close those, and we've done it in less than a month, because it's just a collateral underwrite, and it's a function of how sophisticated the treasury and finance teams are. And if we need to bring in someone like Justin or Justin's team to kind of do a little bit more of a forensic analysis of kind of what's going on and where the cash is, then we do that. But depending on, we leverage third parties a lot to kind of get us there quicker. But I think that's a long-winded way of saying the situations that we step into, speed is absolutely critical. So we can't take longer, right? If it's a situation where maybe there's the equity stake that needs to get refinanced out, and you're looking at doing junior capital, that will take longer in this environment. But usually when we're doing things, it's kind of speed is of critical importance. So we really need to get there faster, which is why we do, not lending to the enterprise and lending against collateral makes that a little bit faster.
And that's probably a helpful context for the CFOs and deal teams on this call. Justin, just given some of these concerns, how are you approaching the engagements or counseling your clients these days?
So when we enter, obviously the absolute first thing we do is try to get our hands around cash. So what is the cash profile over the near term, 13 to 26 weeks? And how does that evolve? And then secondarily, what is the collateral base and what is the value of that collateral base in light of the business plan to support either the current debt or refinancing on that debt? To Melissa's point, it's also very critical to us because we're actually oftentimes trying to monetize that collateral. And it's very interesting to look at some of these collateral audits and some of the borrowing bases and look at the assumptions and say, well, that assumption is based off of a ordinary course set of operations without considering that a lot of the problems that are plaguing the companies that we get brought into are driven by a macroeconomic cycle that also affect the payers. So there's actually a high degree of correlation in the distress that's occurring in the company to the distress that's occurring with the company's customers. So something that someone would look at and say, well, maybe the collectability of that in my borrowing base is X%. Well, it all declines at the same level. Because it's sort of a chain reaction. And, similarly with the inventory. So, what is the value of the inventory in an ordinary course versus the value of an inventory in a distressed business cycle, where you could have bespoke products or alternatively could be selling them to people that equivalently aren't paying you on the AR. So really understanding the unwind of that collateral base and what is the value of that collateral base, not in an analytic sense, but in an actual operating, mode, and how do I recognize the value of that collateral is critical. And then how do I engage with the lenders given the cash flow, the business prospects, and the value of the lender's collateral? When is the appropriate time to engage? How to engage? And what is the approach? We're always early is better. Transparency is better if the relationship is such that early and transparent engagement leads to a positive outcome, because obviously, some of these instances aren't instances where the companies themselves have terrific relationships with the lenders. So trying to develop a strategy to approach the lenders that's collaborative in the event that A, the relationship supports that collaborative engagement, and B, the collateral supports what we're trying to ask, I think is critical. And understanding those dynamics immediately is critical. And then obviously figuring out what difficulties could exist in the structure, again, from a people, process, systems, data perspective, to ensure that what we're going with is something that we can actually execute against, that we can stand behind, and we can gain credibility given the past relationship.
Excellent, thank you. That's all a helpful context, I think, for the CFOs and operating partners listening in today. But maybe let's take a step back for just a second and help us understand how direct lenders in this space manage or think about the investments post-close. Abik, how often and in what forum do you typically discuss your investments internally?
Yeah, so perhaps to start, so we typically back founder, owner managed businesses, entrepreneur-led businesses. So we invest in these companies through a debt-like instrument, preferred capital, but also are in the equity of these companies. So we typically take equity through either common equity or warrants, or a combination of common equity and warrants. So we always sit on the board of these companies, and hence, our interactions are obviously very regular. We discuss in investments on a weekly basis, if necessary, more regularly. And really, these companies, we are typically the first institutional capital provider to these businesses. They are established companies, but they typically look to us for support, not just when it comes to financial reporting, governance, but a number of other things, their digital transformation strategy, perhaps. So we have a value creation team that supports them with a number of these elements in terms of growth, but also just overall professionalization of their businesses. So naturally, we need to stay very close to these companies. But even we're not in the businesses every day, so we will miss things now and then, and that's why I think it is obviously very crucial to stay close to these companies and have that regular dialogue. And even if I think back to sort of my days as a direct lender, I think it was extremely important to have that very regular information. Monthly management accounts are great, but if you don't have that sort of regular dialogue with the management team, with the CFO, CEO, I think it's quite difficult to understand what's actually going on in a business. I mean, if you get monthly management accounts 45 days after the month, you're always sort of somewhat behind the actual reality. And I know that has been compromised a bit, certainly over the past few years, and hopefully the current market environment has helped to shift the goalposts somewhat in terms of getting that those control rights, those information rights, negative control rights, but information rights are a crucial part of that. And so I think hopefully that sort of goalpost is shifting back in lenders' favor, because it's crucially important to know what's going on.
Agreed. Great perspective. How about you, Melissa? Different way of thinking through things. How do you guys address it internally and think about the portfolio performance?
Yeah, I mean, I agree with a lot of what was just said, particularly with lenders having, the requisite, what we view as the requisite access to information. I think for our investments, because the nature of the situations that we're stepping into, they're inherently high touch situations. So for us, managing investments is certainly not a one size fits all approach. On the one hand, we frequently are stepping into situations where maybe you're in forbearance, maybe there's a liquidity need, maybe it's a maturity issue. And if we funded a rescue financing or a debtor in possession loan, that probably requires near daily monitoring. But on the other hand, we also invest in businesses that require maybe a creative structure to fund a big CapEx need. And something like that maybe gets monitored monthly. So the approach to managing the investment really depends on the investment itself. But I would say from our perspective, what is consistent, and this is something that, we like to think differentiates us a bit from some of our peers, is that we try to be extremely responsive to timely needs, particularly around amendments and incremental financing. So we actually set up our whole investment team and our committee to have the decision makers be on the front lines. So the majority of our 5-person investment committee is comprised of senior team members who lead deals and have direct relationships with our borrowers. So what that translates to is the ability to consistently get amendments done in days, not weeks. So we, I think like I said, the situations that we're in, we being responsive and being able to react and fund quickly is of paramount importance. And hopefully having that peace of mind lets the management team kind of operate and execute versus just consistently having to talk to lenders and recreate the wheel on reporting packages, because that's typically a waste of resources, at least in our view.
Great. I think the responsiveness is really important, as you said, in today's market and just the climate. I think a big question that's probably on the minds of a lot of CFOs, especially those who haven't needed to tap the capital markets recently, is how has the approach, I know we've talked a little bit about timing and sort of testing some of the assumptions, but how has the approach mindset around valuations impacted structures and terms these days? We know that historically, or at least over the last probably 5 years, flexibility was a key part of documentation. Have you guys seen a shift in this philosophy? I guess I'll start with Max. What are you guys seeing these days around, just if we're comparing and contrasting today's environment to, a few years ago?
Yeah, I mean, I think, and again, given how frothy the market was the last couple of years, I think loan to value, or LTV, as our industry calls it, wasn't that big of an issue. I mean, I think you were seeing such high valuations with so much equity behind senior debt, or even frankly second lien or junior debt, or even behind holdco or structured equity. It wasn't really a point of material conversation. It's becoming more of an issue. I do think valuations, from what we're seeing, really in the last month or two, have shown some signs of recovery for kind of very strong kind of businesses. Not dissimilar as far as EV multiples from what we saw kind of, in the go-go days of, which is crazy to say, of 21. But I think the biggest issue that's hindering or altering structures is frankly the elevated base rates. So, historically, when we would underwrite a deal or think about the context of a debt package, it was centered around leverage. I'd say these days, leverage is a derivative of what we think a business can support via interest coverage, debt service, and fixed charge coverage. So what we do now, which is kind of inverse of what we've always done, is instead of saying this sector, this business should be at a 5.5, 6.5, whatever it may be, multiple. What is this? Is this a taxpayer? Which there's been some material changes this year on R&D and other things. So like really drilling into taxes, working capital, and interest coverage, and kind of saying what is the most debt we think is prudent for this business to kind of take on. And then, based upon that math, here's what the leverage is. So I think that's been the biggest change. There is still, I think, some material changes in documentations that have kind of lasted or persisted post kind of the widening of the market over the last kind of 15 months. Again, we think those will begin to erode as people rush back into market. But I think the most interesting part of this is, again, the elevated base rates, which are expected to persist per yesterday's Fed meeting, is really driving the structure more so than valuations, in my opinion.
Yeah, great. Melissa, do you want to add anything to those changes that compare and contrast to a few years ago?
Yeah, I mean, I think I agree with everything Max said. Lenders are super focused on interest coverage, fixed charge coverage ratios, and that's driving the amount of leverage that they can take on, notwithstanding the fact that we've seen, particularly when you have private credit taking over for banks in the broadly syndicated market, you're seeing private credit, and these are the 3, 4, 5 up to the multiple $1 billion of debt cap stacks, right? Not lower middle market stuff, but the bigger market stuff. You're seeing private credit guys win those deals because they'll do it at S+6 and 3 points a pick or something like that. So they're putting more pick in their structures to win deals, I think, and to solve for the fact that the cash flow isn't there. I would imagine with the hope that either the business grows into this capital structure and or base rates come down in the next however long their investment thesis. I will take the over on the tenor of how long rates stay elevated, but relative to, I think, those expectations. But at any rate, I think, from a doc perspective, the documents have gotten looser. And what we've tried to do, instead of like competing in the sponsor finance market, at least in my group, there are certainly parts of Soundpoint that compete in that market. But for us, we don't find that we add a lot of value by competing on price and doc structure. So what we've tried to do is structure investments that kind of utilize, I don't want to say loopholes, but it's effectively loopholes and ways to carve out different pieces of collateral from the existing structure. So, an example of something that we did last year, we did a $75 million financing for an international auto parts company, which is a combination of multiple businesses that a private equity firm acquired out of bankruptcy. The company had negative EBITDA. They had an existing term loan lender, but the company had just won a major contract to be the sole source supplier for a big OEM in Europe. But again, they had negative EBITDA. They had international aspects to the business, so not a lot of direct lenders were lining up to do more traditional financing. So what we did was we created an AR facility whereby we consolidated all of the local factoring lines in 5 different European jurisdictions. Then we added in the domestic AR into one facility. And because it was off balance sheet and we only had liens on the AR, there were no covenants on the operating company. So management was kind of free to run the business and execute. But we also, because most docs allow for the securitization or sale of AR, you kind of worked around the existing confines of the docs. And to be honest, the term loan lenders were somewhat relieved, I think, that we were able to provide this liquidity and let the company execute. So I think that's just an example of how we're trying to find leverageable assets within a business, and kind of use some of the flexibility, if you will, within the docs to put a more creative structure in place.
Hearing a lot of creativity and flexibility as themes. Let's shift to the relationship between the company and its PE owners. In this current environment, Abik, what are PE firms and owners looking for from their executives?
Yeah, look, I think, and not just in this current environment, I'll give a sort of more general answer, but I think, it's a healthy degree of resilience. So CEOs dealt with difficult periods, has faced setbacks, difficult challenges. I think you need that because that you really sort of get to know someone when they're in that sort of crisis mode. I think the most important thing for a CEO is to not panic in difficult situations, and so I think that's what we look for first and foremost, and probably in this current environment, it's ever more important. But then I think team building. I mean, the usual things like someone who can actually build a team, and that is particularly important for the businesses that we back, which are yes, founder, owner, entrepreneur led, but eventually they might sort of look to step back and hire a professional CEO or someone who comes from outside the family or outside that sort of original founder group. And we invest in middle market businesses, so it needs to be leaders who are willing to roll up their sleeves. We've had interviews with people who the first question they ask is, how many other people can I hire, and what team will I have, and will I have a PA, et cetera, et cetera. Those are for us, especially for middle market businesses, I think red flags, because there's only so much that a middle market business can afford in terms of team and staff. And so it really needs to be people who are willing to roll up their sleeves and really sort of drive the bus themselves if necessary.
Justin, how about you? Maybe a little bit different perspective, but what are you hearing these days, or how are you advising management teams dealing with their owners?
Yeah, I mean, I think a proactive approach is obviously superior to a reactive approach. Having data to support conclusions is important, but equally finding combat effective, I think, to Abik's point, finding combat effective executives is very important. And we work a lot with, I'd say, we work with large organizations, but we also work with the upper middle market. And I think oftentimes people think CVs are solutions to problems, and CVs are rarely solutions to problems. I think you have to find people that they themselves can solve problems on behalf of themselves and on behalf of the owners, and they're not looking to an army of people, because, you know, it's having combat effective people that have gone through these cycles before is very critical, and making sure that they are themselves effective and operable without a team and a legion of people and without a team and legion of systems, I think is critical, because those people then do find solutions to the problems that plague some of these organizations as they get into these deeper cycles. And, you know, people that have always been supported by an underlying 1,000 other people. And so when they look behind them, they have an army, they might not be effective in some of these circumstances. So I think that's a critical point. And having the PE sponsors actually assist in finding those combat effective people are also critical, because I think oftentimes the people that cause the problems are not the people that are going to get you out of them. And so if a PE sponsor is having a problem with a particular portfolio company, I wouldn't rely on the portfolio company necessarily to find a solution to the problem that it itself may have caused. So it's, you know, finding professional management for sure, but ensuring that professional management is combat effective in a very discreet and very hands-on way, and not combat effective because they necessarily were the CFO of or COO of a public company that had a legion of 10,000 people. Because oftentimes those individuals are figureheads, they're not executors and operators. And what we look for are executors and operators. So even if they look behind themselves and there's no one, they can get out of the foxhole and be successful.
Great. Maybe just to take that a little bit further, well, I'll ask one more question before we kind of jump to some questions that we've had from the audience. But what do each of you think is the best practice in terms of communication style for management teams and PE firms or investors? And maybe if you have an example you can provide to the audience, that would be helpful. I don't know. We'll jump in maybe with Max. You want to provide some color on it?
Yeah, I mean, I think, again, there's a lot of challenges right now. And I'll give a real-time example of an industry that's suffering pretty materially. But I mean, I think part of it's this open line of dialogue, right? I think your lender shouldn't necessarily be perceived as an adversary or, you know, someone that's not there. I mean, most lenders, especially in the middle market, core middle market, and let's kind of on this, we're aligned. I mean, we want the business to succeed. We want the business to ultimately flourish, and ideally, you know, we always joke like in direct lending, private credit, you know, have a payoff or a charge off. So everyone only wants a payoff. So I mean, I think there's alignment, and last thing any lender wants is a negative surprise. So, you know, in a time like this where there's volatility and perhaps you're focused on cash flow, given the elevated rate environment, perhaps you're a CFO or a controller managing a 13-week cash flow. You know, there's going to be inherently, we know they're not accurate, you know, but you're going to have volatility and, you know, collections, and it's kind of having a conversation and being proactive with your lender. The other thing we've seen a lot of our companies do is, you know, we have 400 plus borrowers. So like, you know, a real example is the freight market right now is a really tough spot. We have, you know, a lot of exposure to transportation logistics. Within that portfolio, though, we have visibility on the gross net revenue margins across 20 different companies. We have, you know, perspective on kind of day rates and other critical KPIs that our borrowers don't have. So what we've seen is a lot of our companies, and that'd be often the CEO and the CFO, kind of call us on a pretty regular cadence and say, what are you guys seeing this month? Like, what are you seeing across your portfolio as far as day rates? Have you seen a resumption of this? Are you seeing further degradation in margins on the gross net spread as the excess capacity in the freight market is starting to kind of, you know, cause compression? So, and they're focused on, you know, trying to understand what their peers are, and we can do that in a blind basis where, you know, if they were to call a direct competitor, they're not going to have that candid of a conversation. And we're seeing management teams use that information to try to pivot and change their go-to-market strategy to perhaps, you know, alter the curve within what is, again, the freight market right now is in a tough spot. But I think the best thing you can do is maintain open dialogue. I think a lender that has respect and a good relationship with management teams, it leads to trust, and it leads to them be able to move quicker and potentially get things approved with their respective institution that might not otherwise kind of hunt, just given the relationship itself. So there's definitely some intangible benefits there.
Abik, how about you? You seem to have a lot of collaboration.
I was just gonna say, I mean, I was gonna, give the great answer upfront and honest, stating the obvious, and that open dialogue. But I think one thing that I think has been a learning for us over the years is to really have a sort of a holistic view in terms of starting with the CFO. What is the incentive package that CFO has? Because sometimes CFOs that have a management incentive plan and see a potential payout down the line might communicate differently with you than someone who's just a quote unquote a salaried employee. And so I think it's sometimes very important to sort of read between the lines and see what is a CFO actually telling you or communicating. We have seen situations where CFOs tend to paint a much better picture than the actual picture, just given the incentives that they have. And so that sort of holistic 360-degree view of what the incentive package is that might underline or might sort of drive some of their communication is something that I think is quite important.
Great. I'm gonna go to the audience questions. This first one, we've heard a little bit of this in some of your answers, but curious to know what your 2024 interest rate expectations are. And then secondly, a view on how the current credit environment impacts valuation multiples and M&A. So Melissa, I think you said you were going to take the over. Not sure where that is, but what are your firm views on interest rate environments, and how do you see that impacting the M&A market?
Yeah, I mean, look, there are people that are much smarter than I am making these predictions about where rates are going to go in the Fed dot plots and whatnot. But I think by and large, I think, we're going to have to, the view, I think 6 months ago and talking to a lot of people were like, yes, the Fed will raise rates, but then they'll bring them back down. I was like, okay, but in my view, 4 to 5% is normal, right? Like that is a normal level of interest rates, not for the last 10 to 15 years, but that is normal. So, maybe at the end, towards the second half of 2024, I think is maybe the current outlook. Maybe the Fed starts bringing rates down, but to me, over the long term, and I saw a model the other day that another lender sent me. They're trying to get us to buy them out of one of their positions. And they had, starting in the second half of 2024, like 3.5% interest base rates going down to 2% by the end of 2025. I just didn't think that it certainly wasn't conservative. And I don't know how grounded in reality that is. Maybe that is what happens. But I think if you were to tell me that rates are going to be 3.5% through 2025, that would not surprise me at all. So, and if it's 3.5, is it 4.5? Is it 5? Is it 2.5? I don't really know, and I don't know when. But I don't know that we're going to get a terrible amount of certainty. I think what will drive M&A markets is just the secular shift in more money being allocated to alternative assets, whether that's private equity, whether that's private debt. There's just been a ton of money moving into these asset classes, and it's not going to stop. And that's because if you look at as a percentage of pension funds, endowments, other institutional investors, as a percentage of their total investment portfolio, alternatives is still often like 10, 12, 15, 17%. So there's still room to grow. There's still white space. I have conversations with LPs all the time. Like a lot of my peers in the debt market, we're always fundraising, right? So a lot of them are still getting educated on the market. So I say all this because there's been a lot of money put into these asset classes. I believe that there will continue to be money put into these asset classes. It's a secular shift. And that's what's going to drive a lot of activity in M&A and in direct lending, I think. And that probably is a big part of what's propped up multiples and kind of what Max was talking about before. So I think just the amount of money that's in private equity and private debt is just going to continue to fuel activity. And whether rates are 2.5% or 4% in 2025 or whenever, I don't know if that's so much of a determining factor. It's just the pure amount of liquidity that's been put into the market, where maybe you had a Fed put for the last 10 years. Maybe now you've got this other type of liquidity put in the private market, if you will, I guess.
Great. Max, anything to add on that? I think
Yeah.
Melissa mentioned her views.
Yeah, we spend a lot of time on this, as do others, and we have like an internal, group of economists that are focused on a lot of the major, both U.S. and global kind of macro indicators. It's interesting. The Fed meeting was kind of as we expected. I think it was kind of a mixed message between dovish and hawkish. It does seem though, like if you look at the forward curve and how we model it, you're looking at rates predominantly in the 5s throughout 24, and you might tick down to kind of high 4s by the end of the year, but we're expecting it to kind of remain elevated, which again, if you'd asked me 6 months ago, I'd have told you, we were going to hit a wall, it'd have been a hard landing, and the Fed would, have to immediately pivot, and we'd have a rapid drop. But it doesn't appear that's the case. What's really interesting, and I agree with Melissa's comment, which is, if you've been doing this long enough, you go back to the early 2000s, LIBOR at the time was high 5s. And that's why back then, and direct lending, it was traditionally a bifurcated senior mezz structure with total leverage of 4 times, 4.5. But if you look out now beyond 24, I think what you're seeing is the real deep forward curve still in the mid to high 3s. And I agree with Melissa, which is you look at 100 years of, or 50 years of data, that kind of is closer to the mean. Versus an outlier. So I think we're settling into that. The only wild card we can't figure out is there's a pretty large spread between GDI and GDP, not to get deep in economics, which is very unusual. There's been a lot of seasonal and other adjustments from the BLS that is causing some divergence between some key indicators. And that's one thing where perhaps you could see that result in a more rapid decrease in by the Fed if it comes out that some of these seasonal adjustments coming off the pandemic, which it's not easy to forecast, were perhaps materially incorrect. At which point you see some pretty material downward decreases to GDP. At which point people kind of realize perhaps rates are a little elevated. But I mean, at this juncture, I would assume kind of 5s to high 4s through the remainder of 24. And the other question we get a lot from CFOs is LIBOR or SOFR contracts. For a while there, we were advising to try to, if you can, to work with your amortization analyst, do a ladder, 1, 3, and 6 month. At this juncture, I would say you probably want some shorter tenor locks as you kind of look out, so you're not stuck in a 6-month lock if rates do drop. Again, I'm not smart enough to tell you exactly how to do that, but it is something we are watching, and given those companies are unhedged on their floating rate.
Thank you both. Great answers for a highly complex situation we're all trying to navigate. We are coming up on time, but I want to try and squeeze in 2 more questions. Justin, for you, interesting question around failure, and what do you see as creating failure for CFOs in sort of challenging situations? Is there anything that you can point to that maybe has consistently created failure, or maybe said another way, what to avoid?
Yeah, I think, what to avoid. Look, it's a very loaded question. I think what has consistently caused failure and what we've seen in the past are obviously overly aggressive business models not supported by fundamentals. I think that's point 1. Point 2 is not making data-driven decisions and not having a forward outlook that's data-driven. It's having a forward outlook that might be capital markets driven and assuming capital markets are going to solve problems. Capital markets can't solve problems, and so you need to not, at least not now, So people need to sort of tend to their own garden and not rely on someone else to solve their problems. I think the third is again, the people data process discussion I was having earlier. I think, oftentimes relying on the people that created the problem to solve the problem is not a very good solution. And so what we often see in a lot of the PE clients that we work with is the PE sponsor comes in and assists, because the PE sponsor has a much deeper bench of talent, and the PE sponsor has a much deeper ability to recruit. And so, working collaboratively with the sponsor to solve your people problems is probably point 3. And then point 4 is very active liquidity management. Those companies that do not succeed oftentimes in our books, or that have the most deep distress, are the ones that haven't actively managed liquidity and actively managed relationships so they can actively manage liquidity, and or pivot, to Melissa's point, quickly, because they've torched their relationships with either capital providers or their other partners. And as a result, they have strained relationships that don't allow things to occur quickly, because probably historically they haven't seen the problem far enough out. And that sort of relies on that data-driven approach and having the people to be able to model and understand the business cycles and having a forward-looking view, so that you see problems coming down the road, you can actively address them in time and have the support of people that you've been collaborative with over the past of your relationship, so that you're coming up with a solutions-based result, as opposed to a negotiation where someone's trying to strong arm another, or it's just a negotiation that's born out of leverage and stress. And so you get the best deal that you can get because you didn't come to the table early enough to negotiate the best deal that you could.
Thanks for that perspective. I've heard a lot of great themes here, and I think takeaways for our audience. Justin just gave a lot of key points there. Before I turn it back to Callum to wrap this up, would be curious to hear from Max, Avik, and Melissa. Just what would be your key takeaway or advice, or top 2 that you would give to the audience, maybe as parting comments?
Yeah, I guess I'll start. I think use all the resources you have available. We talked about, systems and IT. One consistent theme I saw in the last couple of years of distress was new ERP systems. So while systems and IT is great, I think going through a 1-year implementation and consolidation of systems can cause blindness to data, and that's where you've seen a lot of issues in volatile times and supply chain kind of constrained environments. So, I think you want to be careful about, biting off more you can chew, and make sure you try to use all your resources, whether it's a private equity partner, consultants, industry research. We've seen some CEOs really, I think, get a lot out of, networking and kind of executive kind of relationships. Use your lender, keep an open dialogue, and I think the friendlier and the more transparent and open and honest you are with your lender, the more you'll probably get out of them. The other piece, if you're going into a point of distress, the way we approach it, which will carry Melissa's perspective, when we think about this with our equity sponsors, it's kind of shared pain. If there's something off the rails, we're willing to contribute PIK and kind of, relieve some of the pressure on cash flows via picking some current pay on a pari basis, but we want to see some real equity come in alongside of us to kind of help bolster liquidity. And it ties into kind of where Justin's going. We need to see a pretty concrete plan on kind of how we're going to get from where we are today and what got us into the situation to a kind of a path out of it, which is underpinned by data and analytics. Those are my main pieces of advice is, again, the lender can be a great asset. They can, I know, be perceived as a pain at times, but they can also provide a lot of value to you if used appropriately.
Great. Melissa, you want to add your comment?
Sure. Yeah, I agree with Max. I think, when things look like to be a more troubled situation, I think feeling like the management team and the sponsor has some real continued interest in keeping the business afloat speaks volumes to us as lenders. So that's obviously critically important. And, I think the piece of advice maybe is, I guess, just keep doing what you're doing. I think dealing with dealing with a lot of us is often an unenviable job, and we really, really appreciate when a management team knows their stuff, but also tells us what they missed. So I think just keep doing what you're doing, and we'll try our best to stay out of your way.
Great. I think it was Abik who said resilience. I think that's right. Abik, why don't you give us parting comments, and then we'll turn it back to Callum to wrap up.
Sure. No, look, I mean, maybe just to add to whatever everyone said, I think, and that is obviously a self-serving comment, but I think everyone in this panel has a toolkit to provide flexible capital solutions. And so, if you think about banks versus private credit funds, private equity funds, private capital funds generally, I think, we have a lot of tools in our toolkit to help companies navigate difficult times, be it picking interest, as was mentioned, or, doing all kinds of other things with the capital structure that banks, traditional lenders can't do. And so, the parting comment perhaps is to CFOs, you're probably in better hands with private capital funds. Again, a very self-serving comment relative to, perhaps more traditional lenders.
Great, thank you, Callum. I'll turn it back to you to wrap up right on the hour.
Fantastic, thank you, Jen, and especially thank you for running that so smoothly. If anyone's ever run a webinar before, you know just how hard it really can be. Also, like to say thank you, obviously, to Abik, Justin, Max, and Melissa for joining us and providing your insights this morning. Really fantastic. I think we've covered a lot of topics here, and hopefully everyone has gained something from this hour. Thank you to everyone who's joined us live, but to a lot of you who are going to be watching via recording. Obviously, like I mentioned, if you have any questions unanswered, you wish to discuss any topics further with either myself or with any of the panelists here, please do reach out to me directly after the event. In all cases, many thanks, much appreciated. Have a fantastic rest of the week, and goodbye all. Thank you.
Thank you.